Everyone tells you real estate is how regular people get rich. Almost nobody tells you how it actually works, or how fast it can wipe you out if you get it wrong. A friend of mine, Dana, found that out the hard way, and figuring out where she went wrong is honestly the fastest way to understand this whole thing. So let's get into it. Here's the first thing nobody says out loud. You don't need $200,000 in the bank to start.
You need $200,000 less than you think, because real estate is the only asset class where a bank will hand you 80 to 90% of the purchase price and let you keep all the upside. That's called leverage, and it's the entire reason real estate builds wealth faster than almost anything else, and also the exact reason it destroys people who don't understand it. Picture two people, same year, same city, same $30,000 in savings. One buys $30,000 worth of stock in an index fund. The other uses that same $30,000 as a 15% down payment on a $200,000 rental property. Say both assets go up 5% that year. Completely normal, unremarkable growth. The stock investor made $1,500. The real estate investor's property is now worth $210,000. That's a $10,000 gain on the same $30,000 they started with. Same market movement, more than 6 times the return, purely because of leverage. That's the math nobody explains at the dinner table. But here's what they also don't explain, that leverage cuts both ways. If that property drops 5% instead, the stock investor loses $1,500 on paper. The real estate investor loses $10,000 of their $30,000, a third of it gone on a small market dip. Leverage doesn't make you rich or broke. It makes whatever happens next happen faster. This is basically what happened to Dana.
She rushed into her first property without understanding this, and a rough first year taught her the expensive version of this lesson. So how do people actually start without blowing themselves up? 3 ways, and they are not equally risky. The first is house hacking. You buy a duplex or a small multi-unit, live in one unit, rent out the others, and let your tenants cover your mortgage. This is genuinely the lowest risk entry point that exists, because you can qualify with an owner-occupied loan, as little as 3 to 5% down, instead of the 20-25% investors normally need. And worst case, if a tenant's late on rent, you're not homeless, you're just annoyed. People have used this single move to go from 0 properties to 5 within a decade, simply by repeating it. Live in it a year, buy the next one, rent out the last. The second is a straight rental property. You buy, you rent it out entirely. Someone else's rent check covers your mortgage, your taxes, your insurance, and hopefully leaves you $200 to $400 a month in actual cash flow. Sounds simple. Here's where people get it wrong. They calculate the mortgage payment and stop. They forget property taxes climb. They forget insurance climbs faster. They forget a roof lasts 20 years, and then it doesn't, and it's $12,000, due immediately, no negotiation. The number that actually matters isn't your monthly rent minus your mortgage. It's your rent minus everything, including the stuff that hasn't broken yet. The third path skips owning property entirely. A REIT, a real estate investment trust, which is basically a stock that owns buildings instead of a company. You buy shares, you get paid dividends from the rent those buildings collect, and you never once have to answer a 2 a.m. call about a broken water heater. Lower returns than doing it yourself successfully, but also 0 tenants, 0 toilets, 0 2 a.m. calls. Genuinely the right answer for most people who want real estate exposure without becoming a landlord. Now, the mistake that actually ends people's real estate journey before it starts, they buy the first good deal they find without running the real numbers. Here's the rule that separates people who build wealth from people who buy a slowly draining money pit. It's called the 1% rule. If a property costs $200,000, it should rent for roughly $2,000 a month or more. Below that, you're often subsidizing a tenant's housing out of your own pocket every single month and calling it an investment. The other mistake? Buying with no reserve fund. You need 3 to 6 months of mortgage payments sitting in cash before you ever close. Because vacancies happen and repairs happen, and they happen at the worst possible time. Never the convenient one. Here's the part that actually matters more than any of this. Real estate doesn't make you rich in year 1. It makes you rich in year 15. When the mortgage is paid down by someone else's rent check, the property's worth double what you paid, and you're still holding it.
The entire game is buying right, holding through the boring years, and not panic selling the first time a tenant is late. You don't need to be rich to start. You need one property, bought correctly, held long enough to matter. That's it. That's the whole formula everyone made sound complicated. Dana learned that the second time around. She ran the numbers, checked her reserves, and 5 years later, that boring property is the best financial decision she's ever made. If this actually made real estate click for you, follow for more breakdowns like this. And drop a comment telling me which path you're leaning toward. House hacking, a straight rental, or just starting with a REIT.